Over the past 7 years of investing, I have made over $100,000 from buying, holding, and then selling stocks. I have more than doubled my stock position just in the past year. Hey everyone, and welcome to FinTech. In this video, I'm going to go over some basic rules of investing, the types of companies that I like to invest in, some of the trading strategies that I use for buying and selling stocks, and finally, some potential mistakes that investors might make while investing in the stock market. So hit the like button and subscribe if you find anything useful, and let's dive right in. First off, let's go over some basic rules I always follow when investing. Don't panic and sell. Eventually, the stock market is going to crash, and you're going to see more and more people selling out of the market, headlines saying that the market's never going to come back, and you're going to feel like you need to sell. But because you know this, you're probably going to hold on for a little bit longer. Then as more people exit the market and you slowly lose more and more money every day, you're going to get more and more anxious until eventually you finally decide to sell out of the market. Well, guess what? The day you decide to do that is the exact bottom of the market, because after even you have decided to sell, there's not going to be anybody else left who hasn't sold their stocks, and you're going to miss out on all the upside that you would have gotten by just holding on to your position. One of the challenges of the stock market is that it forces you to think in a statistical way rather than a cause and effect way, which studies have shown is very counterintuitive for most people. I always think of an example of World War II planes returning from combat. There was a mathematician named Abraham Wald who was tasked with trying to determine where they should armor planes that came back from combat the most. Most of the officers looked at the planes that were coming back from combat and saw that they were being hit in certain areas more than others, so they thought they should add more plating to these areas. Wald disagreed with them and said that they should actually add more plating to the areas with the fewest holes. This was because planes that were getting hit in these areas just weren't returning from combat at all, so the data set that they were looking at wasn't representative of the sample as a whole. This is just one common example of a human bias that could affect you called survivorship bias. Investing is full of these kinds of pitfalls, and that's partly the reason that so many investors make the exact wrong investment choice. Next, can you make over 20% per year in the stock market? Yes you can. I've seen this done over and over again by smaller investors. Now you might say, wait a second, even Warren Buffett hasn't averaged 20% per year, but my counter to that would be Warren Buffett just has so much more money to worry about that it's a lot harder for him to grow at that rate. Warren Buffett making 20% on his portfolio is something like $200 billion. You making 20% might only be $20,000. It's effectively the same thing as trying to turn a tank versus turning on a bicycle. You're just a lot more nimble than the bigger investors, so you can make a better return if you know how to use your mobility. Next, and this one is probably going to be controversial, but don't over-diversify. When I first started investing in stocks, I had probably 25 different positions in my portfolio, even though I had less than $5,000 invested. I had so little money allocated to each company that in a lot of them, I only had one share, and I couldn't even afford to buy certain companies because I didn't have enough money in my account. If you're investing in 20 plus stocks, I don't think you can give each position the individual attention it needs and deserves. I recently released a video on how to pick and analyze stocks for beginners, and if you were to follow the steps in that video for 20 different stocks, it would take you more than 24 hours a day. I found the sweet spot to be around 10 to 12 positions in my own portfolio at a time. Any more than that, and I just can't give each the attention it needs by listening to all the different earnings calls, reading all the different reports on it, and keeping up on news about the company. One way I like to think about this is if I have 20 positions in my company, does it really make sense for me to put money into my 20th highest conviction position rather than the rest of the positions? Doesn't it make more sense to just take the money that would have gone to that lower conviction position and put it into one of the higher conviction ones? If you're looking for diversification, just buy an index fund. But if you're looking to consistently beat the market, over-diversification can be counterproductive. Now let's talk about the types of companies I like to invest in to achieve high return. Ideally, I like to invest in companies that have a high rate of revenue growth, and ideally one that is accelerating over time. These are companies that are either bringing on new customers every year or they're increasing the amount that they can sell to their existing customers. Next, I like to focus on companies that have some kind of niche that they can dominate and something that makes them special within this niche. Kind of like a castle has a moat around it that can keep competitors from stealing their customers. This niche also needs to have the potential to be 10 times larger in the future than it is today. Next, I do not invest in commodity companies that are doing the same thing as everyone else. These companies don't have any market power, and so what they charge customers is just going to be the same as what everybody else charges. Airlines, for example, don't really have much control over what they set their prices at. They basically have to set them as low as possible while maintaining profitability, and this isn't the kind of company that I want to invest in. Ideally, I want to invest in a small company that is doing something that its larger competitors either can't or won't. I think an example of this would be Kodak, way back in 1975. They actually had engineers at the company who invented digital cameras way back in the 70s, but they decided to suppress the technology because they thought it would interfere with the amount that they were making from selling film. Well, if there was a company around that time who took that digital camera technology and ran with it in a way that Kodak couldn't, that would be the kind of company that I would want to invest in. Now, over the past 3 years, I've actually added even more requirements for the companies I invest in just because I've been spoiled for choice with so many good companies out there. Now I look for companies that have high gross margins, ideally over 50%. These are companies which, if they can scale their revenue over time, will naturally see a huge increase in their profits once they overcome the fixed costs of just having the company running. This is partly what leads many of my investments to be in highly scalable technologies like software and the cloud. Next, I ideally want recurring revenue through a subscription customer model. If a company has recurring revenue, that means that every year their sales team can focus on bringing on new customers or selling new products to their existing customers and doesn't have to worry about reselling products that they sold in previous years. For example, if you have a company that produces $100 million in subscription revenue every year, their sales team needs to sell $50 million to increase 50% next year. On the other hand, if you have a non-subscription company, which again had $100 million in revenue last year, their sales team has to go out and sell $150 million next year in order to grow 50%. This kind of focus has led me to mainly focus on software as a service companies, which provide some kind of service to an enterprise, which is actually cheaper than the enterprise doing it themselves. This makes it really easy for these companies to grow because they provide more value than they cost. And kind of along these same lines, this leads them to having a dollar net retention rate over 100%, which means that for each company this year who spends $1, I can expect them to spend over $1 next year. Next, the last thing that I consider, and it's kind of a smaller factor, but it is still important, is I don't like companies where over 25% of their revenue comes from a single customer. An example of this is Twilio back in the day. Around 30% of their revenue used to come from Uber, and then one day Uber just announced that they weren't going to use them anymore. Well, this essentially resulted in a black swan event which absolutely tanked Twilio's stock price for a couple years. Eventually, Twilio did recover from this, but the problem with having so much of your revenue focused on one customer means that you have to not only understand your own company, you need to understand that customer to make sure they're not going to pull out anytime soon. Now, outside of these financial metrics, I also try to look for founder-led companies. These are companies where one of the founders of the company still maintains a leadership position that influences the company's direction. In general, I think founders are just more invested in seeing their companies grow. They built the company and it's like their baby, versus someone who's hired to be CEO is more focused on what the company can do for their reputation or to make them money. Now, companies can absolutely do incredibly well after their founder leaves. Think of Apple under Tim Cook instead of Steve Jobs. But in general, especially with newer companies, I prefer companies that are led by their founders. Next, let's talk about the trading strategies that I use to avoid losses and capture as much upside as possible. First off, trading in and out of positions for a short-term gain is counterproductive. If you're investing in companies which you think have the potential to double overnight, it doesn't make sense to trade in and out, effectively earning pennies on the dollar when all of that upside is at stake. Don't waste your effort in just trying to make a few percent when the goal is to make 20+% per year. Next off, I don't invest in options. Options are a zero-sum game where you're competing with professionals who have access to almost unlimited resources who are trying to take your money. Now, is it possible to make money this way? Sure, I think it's definitely possible, but I think it's a lot harder than just giving your money to wonderful companies which are going to grow over time. Next, I stay around 90 to 95% invested at all times. I don't try to leave my cash on the sidelines trying to time a market swing up or down. Between 2000 and 2020, if you miss just the 2 best trading days each year in that time period, you would go from making an annualized return of around 6% to negative 3.79% per year. There is a real cost to not being invested in the stock market, so I only hold cash for a short period after I've sold out of a position and I'm waiting to deploy it to a new position. Now, this next one I need to bring up because I even see popular finance YouTubers like Graham Stephan making this mistake. The price that you bought a stock at should not influence your buying or selling decisions in the future. Just because I bought a stock at $20 and now it's $30 doesn't mean I can't buy more of the stock today. Similarly, if I've lost money on a stock, there's no reason to hold on to the stock hoping to break even, especially if I don't have a fundamental reason for why the stock price should rise in the future. Anytime you so much as hold a stock position, you are implicitly saying that you would buy more of that stock at its current price. Lastly, and this one again may be a little bit controversial, I don't focus on taxes while investing. Now granted, I do a lot of my investing in a Roth IRA, so taxes aren't really an issue for me, but even in my taxable brokerage account, I found that focusing too much on optimizing my tax strategy actually hurts my investment returns. A few years ago, I had a stock that had around a 30% gain in a taxable account, but I didn't want to sell it until I got to a long-term capital gain rather than a short-term one, even though I didn't think the company was going to do that well going forward necessarily. Well, wouldn't you know it, I waited a few months to try to get a long-term capital gain on the stock, and during that time period, the stock price declined around 30%. So I went from a 30% upside where I'd have to pay some taxes on it to a 0% upside where I would pay no taxes on it. Basically, by trying to save a few dollars in taxes, I ended up missing out on the entire gain that I would have gotten. I do think you should take advantage of tax rules to decrease how much you have to pay whenever possible, but I think if you let the taxes influence your trading strategy too much, it can actually end up hurting you more than helping you. Lastly, I'm going to talk about some potential pitfalls and mistakes that investors can make in the market. These are mistakes that I have made in the past and learned from, so hopefully you can take my learnings and you don't have to make these mistakes yourself. First off, don't sell out of a stock because the stock price went up, and don't wait for a stock's price to go down before buying in. If I have a stock that goes up 20% in a couple months, I don't sell it in order to lock in a profit. I sell it if I think the stock is going to go down in the future. On the flip side, if I'm considering buying a position, I don't wait for the stock to go down to a lower entry point before I buy in, because I think the stock is going to go up over time. By waiting for it to go down, I'm essentially betting against my own thoughts on the company. For example, I bought into Zoom after its stock price had already risen 100% in 2020. Now sure, I could have said, I'm going to wait for the stock to drop a couple dollars before I buy in, but if I had done that, there's the risk I never would have bought in, and it would have run up 100% again, and I would have missed out on the entire upside. If you're considering investing in a stock, it's because you think the company's price is going to go up over time. So don't bet against that by waiting for it to drop a couple dollars before you buy in. Next, be very willing to admit when you've made a mistake. Warren Buffett has often said his greatest asset is knowing what he doesn't know. Investing can be a very humbling experience, but some of the best investors in the world are incredibly humble people, and I think that that's core to their success. They're not afraid to make a mistake, and when they do, they're willing to say, I don't understand this area well enough to invest in it. If you make a mistake, admit it, try to learn from it, and then move on. Don't throw good money after bad trying to recoup your investment. Finally, don't focus on a stock's past price. Any stock you buy into at some point was much cheaper than it is today. That doesn't mean the stock's going to go back to that price in the future. I think that there's kind of this psychological trick that people get played on them based on the fact that the charts we use to graph stock prices look like mountains and valleys. Intuitively, when we see a stock price go up, we think that gravity is going to need to pull it back down to earth. But in reality, this is just a chart of what the stock has traded at in the past. There's really no useful information there that you can use to predict the stock's future price. For that, you just need to do a fundamental analysis of the company. Now, sorry if this video was a little bit rambling. There was just a lot of information I wanted to get out there, but let me know if you found any of these tips or strategies useful. With that said, I hope you enjoyed this video, and if you did, make sure to leave a like. And if you don't want to miss out on any future videos, make sure to both subscribe and hit the notification bell. I'll see you next time.